What if most investors are not struggling because markets are risky, but because beating the market itself is far harder than it looks? For years, we have chased the next big fund, the top performer of the year, the star fund manager, the perfect entry point. We switch funds after rallies, we exit after crashes, we believe activity equals intelligence. Yet quietly, without noise, something very different has been happening in the background. Instead of trying to beat the market, a growing section of investors across the world is choosing to simply become the market. This idea sounds boring, but boring is exactly what is reshaping global wealth. In India, this shift was almost invisible at first. In 2020, only 7% of all mutual fund money was sitting in passive products. By 2025, that number climbed to 17%. Just steady movement of capital. This is not excitement-driven money, this is conviction-driven money. And that is why this story matters. But what passive investing really means? If investing feels complicated, passive investing was built to keep it simple and reduce complexity by design. Let me explain this. In active investing, a fund manager makes investment decisions such as selecting securities, adjusting portfolio exposures, and managing risk with the objective of achieving returns that differ from a benchmark index. Success depends on human judgment, but in passive investing, we remove that judgment. If an index like the Nifty 50 owns 50 companies, a passive fund tracking the Nifty 50 index simply buys those same 50 companies in the same proportion. No prediction, no stock selection, no market timing. Two simple investment routes that make this possible: index funds and ETFs or exchange traded funds. Index funds are bought from AMCs like any other mutual fund schemes, either directly or through a distributor. ETFs, on the other hand, are traded on the stock exchange like any other listed stock, bond, etc. These funds are generally low-cost products. The goal is not to beat the market, but to align with the index as closely as possible. Now, passive investing does not remove market risk, it reduces decision risk. And globally, once this distinction became clear, money began to move. This story did not start in India, it started on Wall Street. Over the last 2 decades, global investors began noticing a pattern. Most active funds were failing to beat their benchmarks after fees. This was not occasional, this was structural. By end of 2023, the United States crossed a historic milestone. For the first time ever, passive assets exceeded active assets. As of October 2025, passive AUM stands at $19 trillion, while active AUM is about $17.4 trillion. This transition did not happen because active funds vanished. It happened because costs kept compounding while performance struggled to justify them. India today stands at a similar point where the US stood more than a decade ago, aware but not yet saturated. Now, the biggest pressure on active investing has not come from theory, it has come from results. Over long time periods, a larger proportion of Indian active funds have underperformed their benchmark indices. Across categories, the long-term trend over the past 5 years remained consistent. Large cap, nearly 69% of funds underperform the Nifty 100 TRI. Mid cap, underperformance against the Nifty mid cap TRI exceeded 79%. And small cap, close to 67% of funds lag the Nifty small cap 250 TRI. This does not mean all active funds fail. It means consistent repeated outperformance is rare. When investors repeatedly see that most funds fail to beat the index over long periods, a natural question arises. If the outcome is uncertain and the cost is certain, should the portfolio structure be rethought? This question opened the door for passive investing. Now, India entered the passive investing journey later than developed markets, but when India moves, it moves at scale. Between March 2020 and November 2025, index fund AUM grew at 92% CAGR. ETF AUM grew at 40% CAGR. By November 2025, index fund AUM crossed 3,24,800 crore rupees. ETF AUM crossed 10,46,655 crore rupees. This tells us the shift is no longer speculative, it is behavioral. Why investors are moving towards passive? First, cost advantage. Passive funds generally operate at a fraction of the cost of active funds because passive funds do not need to bear research-related expenses unlike active funds. Second, low portfolio turnover. Active funds generally tend to have a higher portfolio churn. Rebalancing frequency for passive funds is on a periodic basis and may result in lower portfolio churn as compared to active funds. Now, lower churn means less frequent buying selling of securities in the scheme portfolio, lower trading costs, and better compounding efficiency. Third, market aligned performance. Many investors are no longer chasing the idea of beating the market every year. Matching market returns steadily over 15 to 20 years is now considered an acceptable and disciplined outcome. Fourth, transparency. Since passive funds track the underlying index, investors have a clear view of their holdings with minimal chances of style drift or unexpected strategy shifts. None of this guarantees high returns, but all of this controls uncertainty and cost. Now let us simplify everything with a 100 rupee example. Out of every 100 rupees invested into an active equity fund, generally around 1.5 to 2 rupees gets attributed towards expense ratios, which includes distribution commissions, research costs, portfolio churn, and operational overheads. In many index funds, the same cost is in range of 0.5 to 1 rupee. This difference looks small, but over long periods, this difference compounds aggressively. Over 20 years, even a 1% annual cost difference can consume 16.1 lakh of final wealth on a standard long-term SIP. Now, passive investing does not promise outperformance. It simply protects returns from being quietly eaten. Now, let's come to who's actually driving passive in India. Passive investing in India today is still institutional-led. As of September 2025, corporates control nearly 86% of ETF AUM. HNIs hold about 12%, retail investors contribute only 2.5 to 3%. In index funds, the mix is more balanced. HNIs around 39%, corporates around 37%, retail around 23%. Retail participation has historically stayed low because commission in passive funds are lower for distributors, ETF execution requires demat accounts, and awareness matured slowly. However, a structural change is now visible. Retail ETF folios have grown multi-fold over the years. Digital platforms have begun bypassing traditional commission structures. The retail phase of passive investing in India has quietly begun. But passive investing is not without risks. When the market crashes, passive funds also fall. There is no downside protection through stock selection. There is no tactical cash allocation. Most importantly, passive investing requires emotional discipline. In severe downturns, the temptation to exit can destroy long-term outcomes. Active funds will continue to exist because certain market phases reward skilled stock selection. Tactical strategies need human judgment. Many investors still want the possibility of outperformance. Passive does not replace active. However, passive investing helps reduce certain risks associated with active decisions, such as choosing individual stocks or fund managers. So, passive investing is not exciting. It does not give stories of overnight wealth. It does not offer thrill. It does not reward prediction, but it does reward discipline. It shifts the journey from trying to be smarter than the market to simply staying invested in it. Active investing allows investors to make decisions based on their own views and preferences, while passive investing focuses on following a defined investment framework or process. Active fund investing is about chasing winners. Passive is rule-based and systematic. And that shift, quietly and steadily, is what is reshaping Indian investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.